In September of 2001, an energy company that Fortune magazine had called America's most innovative for 6 years running filed for bankruptcy in a single afternoon, and 4,500 years of ledger keeping had never seen a company that size vanish that fast. Enron is one story among many this list will tell, and it will not be the strangest. Long before hedge funds and quarterly earnings calls, a Scottish colony tried to buy its way into the world's shipping lanes and lost a fifth of the nation's wealth in a swamp in Panama. A Florentine banking family financed popes and kings for a century, and then, in one generation, owned nothing at all. This is not a story about bad luck. Company failure turns out to have a small number of shapes, and once you have seen them, you start noticing the same shape everywhere, in a 19th century railway boom, in a Ponzi scheme that fooled regulators for decades, in a photography company that invented the digital camera and buried the patent. This channel does not tell you what to do with your money. It watches what humans have already done with theirs, across 5,000 years of ledgers, and what history did about it. Across the next 100 lessons, you will meet the bankers, the frauds, the visionaries who bet everything, and the boards who looked away, and you will start to recognize, in each ruin, something faintly, uncomfortably familiar. Fortune magazine named the same company America's most innovative 6 years in a row. Then, in the space of about 6 weeks in the autumn of 2001, that company went from a stock price near $90 to filing for the largest bankruptcy the country had ever seen. Enron had built its business on natural gas trading, and then gradually on something harder to explain. Contracts that promised future profits which the company was allowed, under an accounting rule called mark-to-market, to book as current earnings. If a 20-year power deal looked profitable on paper, Enron could claim that profit today, whether or not the deal ever delivered it. When real cash flow lagged behind the profits on paper, executives built a web of off-the-books partnerships to hide the gap, borrowing against the company's own stock to keep the debt from showing up on Enron's balance sheet. The chief financial officer who built these partnerships was later celebrated internally with an award for creative deal-making. Wall Street analysts who should have caught the problem mostly did not. Several kept recommending the stock even after a financial journalist began publicly asking, in print, how exactly Enron made its money. When a hedge fund analyst finally forced the question at an earnings call and got a vague, hostile answer, confidence cracked within days. The stock that had traded near $90 fell to under $1. Thousands of employees who had been encouraged to hold company stock in their retirement accounts watched those accounts empty out in the same weeks the executives who had cashed out early kept their gains. Arthur Andersen, the accounting firm that had signed off on Enron's books for years, was convicted of obstruction and did not survive the scandal either, taking down one of the 5 largest accounting firms in the world, along with the company it had audited. The tower in Houston kept its name on the door a little while longer, and then it did not. When John Law arrived in Paris, France was nearly bankrupt from decades of war, and the Scottish gambler turned economist had a solution that sounded almost too elegant. Replace the country's scarce metal coin with paper money backed by the promise of a trading company's future profits. The company was the Mississippi Company, granted a monopoly over French trade with Louisiana, a territory most Parisians had never seen and knew mostly through advertising. Law became France's Controller General of Finances while still running the company, an arrangement that let him print new banknotes and use them to buy more company shares, which pushed the share price higher, which then justified printing more banknotes. Share prices that had started around 500 livres rose past 10,000 within a year, minting new millionaires so quickly that the word millionaire is sometimes credited to this exact bubble. Ordinary Parisians pawned furniture to buy shares on credit. A street called the Rue Quincampoix became so crowded with speculators that the city posted guards. Then in 1720, holders who tried to convert paper profits back into metal coin discovered there was nowhere near enough gold and silver in France's vaults to honour the notes. Law tried restricting how much coin any person could withdraw, then banned the private holding of gold outright, and neither move restored confidence. Shares collapsed toward worthlessness within months, the paper currency was abandoned, and Law fled the country he had once run, dying in Venice years later far from the fortune he had briefly commanded. Louisiana itself, the territory the whole scheme was supposedly built on, had barely been surveyed and never produced anything close to what its paper price implied. The coins outlasted the paper by centuries. Nearly every landed family in Scotland, and a great many merchants and tradesmen besides, put money into a single trading company chartered in 1695, drawn by a promise that a small colony on the Panama Isthmus could become the crossroads of world trade between the Atlantic and the Pacific. The Company of Scotland raised its capital almost entirely from Scots themselves, since English and Dutch investors, wary of provoking Spain's claim to the region, largely stayed out. Contemporary estimates put the sum raised at somewhere around a fifth of all the money circulating in Scotland at the time, a staggering concentration of a small, poor country's wealth in one unproven venture. 2 fleets of colonists sailed for a stretch of coastline the company named Calla Doc Nia, carrying goods meant to trade with local populations, among them, by one often repeated account, wigs and combs poorly suited to a tropical jungle. The land turned out to be swampy, disease-prone, and already claimed by Spain, which blockaded the settlement. Malaria and dysentery killed colonists faster than any battle did, and word of the disaster took months to cross the Atlantic, so a second wave of settlers sailed straight into the same failing colony, without knowing the first attempt had already collapsed. By 1700 the survivors had abandoned Calla do Nia entirely, and the financial wound to Scotland was severe enough that historians still debate how much it pushed the country toward union with England just 7 years later, a union that, among other things, compensated Scottish investors for their DAREN losses out of a shared treasury. The jungle took back the ditches within a generation. For most of the 15th century, a letter of credit signed in Florence could be honoured in Rome, Bruges, or London, because one family's bank had branches in all 4 cities, and a reputation good enough that popes borrowed from it to pay for building projects. The Medici Bank grew out of the wool trade, and Cosimo de' Medici's careful expansion into branch banking, at a time when the Catholic Church officially frowned on charging interest, and Italian bankers got around the restriction with foreign exchange contracts that functioned as interest in every way but name. The bank's Rome branch, which handled papal finances, was for decades its most profitable, a reminder that being banker to the world's most powerful patron cuts both ways, brilliant while the relationship holds, catastrophic if a pope changes or a loan goes bad. Under Cosimo's grandson Lorenzo, called the Magnificent, the bank's management drifted toward men who were skilled courtiers but mediocre bankers, and branches in London and Bruges extended large loans to English and Burgundian nobles who were considerably better at borrowing than repaying. The Bruges branch alone accumulated bad debts that some accounts put near the bank's entire remaining capital. Lorenzo, more interested in patronage, art and politics than in ledgers, let the bank's oversight slide even as its reserves thinned. When the French army under Charles VIII invaded Italy in 1494 and Florence itself turned against Lorenzo's son Piero, expelling the family from the city, the bank had no political shelter left and no capital cushion either. Creditors moved in immediately, and within the year the institution that had bankrolled half of Renaissance Europe's ambitions no longer existed. The palazzo remained standing long after the ledgers were closed. Augsburg, a mid-sized German trading city, was for a time home to what may have been the single richest private family in Europe. And that family got there largely by lending money to an emperor, who could not otherwise have bought his own throne. Jakob Fugger built the family's fortune on copper and silver mining rights across Central Europe and on textile trade, and then leveraged that wealth into the one business that made the Fuggers indispensable to European politics, lending to the Habsburgs. In 1519, Fugger money paid the enormous bribes needed to secure Charles V's election as Holy Roman Emperor over the King of France, and Fugger later kept a private ledger, according to later accounts, tallying exactly how much he had spent to put an emperor in power, apparently unafraid to remind Charles of the debt. For decades the arrangement worked. The Habsburgs needed constant financing for wars against France, the Ottoman Empire, and Protestant princes, and the Fuggers supplied it in exchange for mining concessions and repayment from royal silver shipments arriving from the Americas. The trouble was that a family bank's fortunes were now tied to one dynasty's ability to keep winning wars and keep the silver flowing, and neither held indefinitely. The Spanish crown, which by then owed enormous sums to Italian and German bankers alike, defaulted on its debts multiple times across the late 15 and early 1600s, and the Fuggers absorbed heavy losses in several of these defaults. The 30 Years' War, breaking out in 1618, then devastated the German trade routes and mining regions the family's wealth depended on. By the mid-17th century, the Fugger name still carried prestige, and descendants still held noble titles, but the vast trading and banking empire Yates-Cobb had built no longer existed in anything like its old form. The emperors kept their crowns, the ledger that paid for them did not. A single tulip bulb of a striped red and white variety called Semper Augustus is recorded as changing hands in Amsterdam in the winter of 1636 to 1637 for a price that by contemporary accounts rivaled the cost of one of the city's Grand Canal houses. The variety existed because of a virus, not yet understood as such, that caused some tulip petals to break into dramatic streaks and flames of colour, making certain bulbs unpredictably rare and therefore, to a market drunk on rarity, unpredictably valuable. Trading moved from florists' gardens into taverns, where dealers bought and sold not bulbs themselves, most of which stayed safely in the ground, but futures contracts promising delivery of a bulb once it was dug up months later. Notaries recorded absurd numbers of these contracts changing hands in the weeks before February 1637, when, at an ordinary bulb auction in the town of Haarlem, buyers simply stopped showing up. Prices that had climbed for weeks fell within days, and traders holding futures contracts at the old high prices found themselves obligated to buy bulbs worth a fraction of what they would agreed to pay. Dutch courts were left sorting out disputes for years, generally ruling that contract holders could settle for a small percentage of the agreed price rather than the full amount, which suggests the legal system itself understood the contracts had been more speculative than binding. The historian Anne Goldgar, studying the surviving notarial records, found far fewer documented bankruptcies than the popular legend of the crash implies. Most of the ruin, she argues, was reputational and social, rather than a nationwide financial collapse. The bulbs went back to being flowers. For close to 200 years, a single trading company paid dividends to shareholders more consistently than most governments paid their own debts, and it did so while running its own private army, minting its own coin in parts of Asia, and effectively governing large stretches of what is now Indonesia. The Dutch East India Company, founded in 1602 and often credited as the first company in the world to issue shares that could be freely bought and sold on an open exchange, built its early fortune on the spice trade, particularly nutmeg, cloves and pepper, defended by fortified trading posts and a fleet that could rival many navies. Through the 16 and early 1700s, the company was, by most measures, the most valuable commercial enterprise the world had yet seen. Its decline was gradual rather than sudden, which made it harder for shareholders and directors alike to see coming. Costly wars defending its Asian territories against British and other European rivals drained resources for decades. Corruption among company officials in the field, who were paid modest salaries but controlled enormous private trading opportunities, siphoned profits away from shareholders and toward individual employees, a problem the company's own directors in Amsterdam struggled to police from thousands of miles away. Competition from the British East India Company, better financed and increasingly better organised, ate into markets the Dutch company had once dominated outright. By the late 1700s, the company was borrowing heavily just to keep paying dividends, propping up its own stock price with debt it could no longer service. The Dutch government, which had come to treat the company's territorial holdings as effectively its own, formally took over its charter and debts in 1799, quietly ending the run of the company that had, in its best years, been worth more than most European crowns' entire treasuries. Its ledgers closed, its trading posts kept operating under a different flag. For much of the 19th century, London bankers who found themselves short of cash for a day or a week could turn to a single firm so reliably solvent it was known, half affectionately, as the Bankers' Bank. Overend, Gurney and Company built that reputation over decades as a discount house, a business that bought short-term debt from other banks and merchants at a discount, and collected the full value when it matured, a conservative trade that rewarded careful judgment about who was actually creditworthy. In 1865, the partners converted the firm into a public limited company, selling shares to outside investors, and the new management, freed from the personal liability that had once made the original partners so cautious, moved the firm's money into much riskier long-term loans to railways, shipping ventures, and iron works, several of which were already in financial trouble. Within about a year, the scale of the bad loans became impossible to hide, and on a single day in May 1866, the firm suspended payments, owing sums that some contemporary estimates placed near £11 million, an enormous figure for the time. Depositors and other banks who had trusted the Outlived name for a generation panicked, queuing outside the firm's offices and, in the following days, outside other banks as well, in scenes London had not seen since an earlier banking crisis decades before. The Bank of England, worried about setting a precedent of rescuing reckless institutions, initially refused to lend Outlived money to cover the shortfall, and the firm went into liquidation. The wider panic that followed forced the Bank of England to lend freely to the rest of the market instead, a response that later became a template for how central banks handle banking crises. The Bankers' Bank never opened its doors again. A Parisian bank built explicitly to compete with rival financial houses and to finance Catholic business interests across the crumbling edges of the Austro-Hungarian Empire, ended up, within a decade of its founding, as the trigger for one of the worst stock crashes in French history. The Union Générale, led by a financier named Eugene Bonnetou, raised money for railway and mining ventures stretching from Austria into the Balkans, an ambitious and genuinely risky business on its own. What turned the bank's difficulties into a national crisis was a separate scheme. Bonnetou and his allies encouraged investors to buy Union Générale's own shares heavily on margin, meaning with borrowed money, secured only by the shares themselves, and used the bank's resources to keep buying its own stock and drive the price ever higher, a practice that amounted to cornering the market in its own shares. As long as the price kept climbing, the arrangement looked like success. In January 1882, the price stopped climbing. Margin buyers who could not cover their loans were forced to sell. The share price collapsed within days, and the bank itself, holding a large share of its own now worthless stock, had no capital left to absorb the loss. The failure spread quickly through the Paris bourse, wiping out savings across a wide swath of investors who had never bought a Union Générale share directly, but held other companies whose credit dried up in the panic. Bonnetou was later convicted of fraud, though he spent much of his sentence abroad rather than in a French prison. The episode left French regulators considerably more cautious about margin lending on the stock exchange for a generation afterward. The bank meant to outdo its rivals ended up ruining half the exchange instead. The same banking firm that had sold enough government bonds to help finance the entire Union war effort a decade earlier found itself, in September 1873, unable to sell enough railroad bonds to cover its own debts, and its failure shut down the New York Stock Exchange for the first time in its history. Jay Cooke had made his name and fortune during the Civil War by pioneering an aggressive bond-selling operation, using newspaper advertising and a network of small-town agents to sell government war bonds directly to ordinary citizens rather than relying solely on large banking houses, a genuinely innovative approach that helped keep the Union solvent. After the war, Cooke's firm took on an even larger project, financing the construction of the Northern Pacific Railway, a transcontinental line meant to open the American Northwest. The railway required enormous amounts of capital, and Cooke's firm committed to underwriting bonds well beyond what investors were actually willing to buy at the prices offered, essentially loaning the railway money the firm did not fully have, on the assumption that bond sales would eventually catch up. They never did, in part because a general glut of railroad securities across the American and European markets had already made investors wary. On September 18, 1873, J. Cooke & Company simply ran out of cash and closed its doors, a firm so central to American finance that its failure alone was enough to trigger a chain reaction. Other banks that had lent to or invested alongside Cooke failed within days. The stock exchange closed for 10 days to stop the panic from spreading further, and the broader economy slid into a depression that, by some measures, lasted longer than the one that would follow in the 1930s. The railroad Cooke bet everything on was eventually finished by other men's money. When a scheme to corner the market in a single copper company's stocks fell apart in October 1907, the fallout reached a trust company whose president had loose toys to tie the scheme, and within days depositors were lined up around block trying to withdraw their savings before the company failed. The scheme itself involved a mining financier, F. Augustus H. Wienzer, and his associates attempting to buy up enough shares of United Copper Company to squeeze short sellers, forcing them to pay inflated prices to cover their positions. The corner failed when the plotters ran out of money to keep buying, and United Copper's stock collapsed within days, ruining H. Weinzer and several associated brokerage firms. The Nik Boca Trust Company, whose president had banking connections to some of the people involved, saw its depositors lose confidence almost overnight, despite the trust itself having no direct exposure to the failed copper scheme. A run began, and the National Bank of Commerce, after examining Knickerbocker's books, declined to continue clearing its transactions, effectively signaling to the whole market that the trust was in trouble. Knickerbocker suspended operations within days, and the panic spread to other trust companies seen as similarly exposed. There was no central bank in the United States at the time to act as a lender of last resort, so the task fell to J.P. Morgan personally, then in his 70s, who gathered the heads of the country's major banks and trust companies into his private library, and effectively ordered them to pool funds to support weaker institutions, refusing to let anyone leave the room until commitments were made. The strategy worked and the panic subsided within weeks, but the fact that the entire financial system's stability had depended on one aging private banker's personal authority alarmed Congress enough to begin the process that created the Federal Reserve 6 years later. No single banker has been asked to do that again. A New York newspaper published a list in the autumn of 1872 of sitting members of Congress who had allegedly received deeply discounted shares in a construction company from a colleague eager to keep federal railroad subsidies flowing, and the resulting scandal touched a sitting vice president and future president alike. The company was Credit Mobilier of America, formerly a construction firm but functionally a vehicle that Union Pacific Railroad insiders used to pay themselves, awarding Credit Mobilier lucrative building contracts on the Transcontinental Railroad, and then paying it far more than the actual construction cost, with the excess flowing back to the same men as company profits. To keep congressional oversight friendly while the arrangement continued, a company director named OHKSAYMZ distributed shares in Cred Mobilier to members of Congress at prices well below their market value, along with the dividends those shares would soon pay. When the scheme became public, a congressional investigation followed, and while it found evidence of the share distributions, it stopped short of proving outright bribery in most cases, since the congressmen involved could argue they would simply made a good investment. Only 2 members were formally censured, Ames among them, and no one went to prison. The railroad itself was still built and remained in operation for generations, which is part of what made the scandal unusually uncomfortable for the public to sit with. The underlying infrastructure worked, even though the financing behind it had been quietly looted by the very officials meant to be building it honestly. The episode became one of the era's shorthand examples for the close, often invisible relationship between federal subsidy and private profit in the age of American railroad expansion. The trains kept running long after the men who profited from building them were forgotten. In a single parliamentary session in 1846, lawmakers approved plans for several thousand miles of new railway line across Britain, far more track than the country's freight and passenger traffic could plausibly support, and ordinary clerks and clergymen who had never owned a share of anything in their lives were among the crowds buying railway stock on credit that same year. Cheap credit and a run of profitable early lines convinced the British public that railways were a nearly guaranteed way to grow money, and promoters obliged by launching new railway companies at a pace regulators struggled to track, each requiring a parliamentary act to proceed and each drawing a fresh round of speculative investment. Newspapers ran pages of railway share prices the way they would once run shipping news, and a Yorkshire businessman named George Hudson, nicknamed the Railway King, became one of the era's most celebrated men by amalgamating lines and paying generous dividends. Dividends that later investigation revealed was sometimes paid out of capital rather than actual earnings, a way of disguising a struggling company as a thriving one. As more lines opened and revealed that many routes duplicated each other, or served towns too small to generate the promised traffic, investor enthusiasm cooled, and by the later part of the decade, share prices across the sector fell sharply. Hudson's own financial manipulations were exposed around 1849, ending his career in public disgrace. The mania's aftermath left Britain with a genuinely useful, if oversized, rail network, built years ahead of what organic economic growth alone would have justified, financed largely by investors who lost money doing it. Historians still debate whether the excess capacity, however wastefully financed, ended up quietly subsidizing decades of British industrial growth that followed. The tracks stayed, the fortunes that laid them mostly did not. Nearly every member of the Georgia Legislature who voted, in 1795, to sell an area of land roughly the size of two present-day states turned out, once the details came to light, to have personally received company shares or outright cash from the buyers. The land in question stretched across what is now most of Alabama and Mississippi, claimed by Georgia under its original colonial charter, and four land companies collectively known afterward as the Yazoo companies purchased the entire tract for a price historians generally describe as a small fraction of its market value in exchange for what amounted to a bribe distributed to nearly the whole legislature. Public outrage, once newspapers exposed the arrangement, was fierce enough that Georgia voters replaced most of the legislature the following year, and the new legislature formally repealed the sale, ceremonially burning the original Land Act in a bonfire on the State House lawn. The trouble was that by then the original companies had already resold portions of the land to other buyers, who had in turn resold to still others, so the repeal left an enormous tangle of competing claims. Had the original sale ever been valid, and if not, who actually owned any of this land now? The dispute eventually reached the United States Supreme Court in the 1810 case, Fletcher versus Peck, which ruled that a state legislature could not simply void a contract once made, even a fraudulently obtained one, because doing so would undermine the security of all property contracts generally. Many small buyers further down the resale chain, who had paid honest money in good faith with no idea the original sale had been corrupt, lost their investments entirely regardless of the ruling, since land they would paid for often turned out to have been oversold to multiple owners at once. The bonfire on the State House lawn settled nothing at all. By the last years of the American Revolution, a soldier being paid in the currency his own government had printed to fight the war could find that the money had lost most of its value between the day it was issued and the day he tried to spend it, and the phrase people used for something utterly worthless was simply not worth a Continental. The Continental Congress, needing to fund an army with essentially no power to levy taxes of its own, financed the war largely by printing paper money called Continental currency, issued in large quantities with no gold or silver reserve backing it and no reliable mechanism for redeeming it later. Each individual state also printed its own paper currency to fund its share of the war effort, compounding the problem. Merchants and farmers faced a confusing patchwork of currencies from different states and from Congress itself, each depreciating at its own pace as more was printed to cover continuing military costs. By 1779, prices quoted in Continental currency had risen so dramatically compared to prices in hard coin that merchants effectively stopped trusting the paper at anything close to its face value, demanding several times the nominal price for goods if payment came in Continentals rather than coin. Congress tried periodic recalls and revaluations to slow the slide, none of which held for long, since the underlying problem, printing money with no backing and no limit, kept recurring as the war dragged on. By the war's end, the currency had depreciated so far that the government eventually redeemed remaining Continentals at a rate of $1 new for every 100 old ones, essentially writing off 99% of the currency's original value. The experience left the framers of the Constitution deliberately cautious about giving any future Congress unchecked power to print paper money. The soldiers who fought for it were often paid in the very money they had learned to distrust. A Confederate paper dollar that could buy a week's groceries in 1861 could barely buy a box of matches by 1864, and within weeks of General Lee's surrender in April 1865, the currency was worth nothing at all, accepted nowhere, its value ending as abruptly as the government that had printed it. The Confederacy faced a financing problem from its first days. It had little gold reserve, limited ability to tax a largely agricultural population, and a Union naval blockade that steadily cut off the cotton exports that might otherwise have brought in hard currency from Europe. Faced with those constraints, the Confederate Treasury financed the war overwhelmingly by printing paper money, issuing far more currency than the underlying economy could support with actual goods and services. Prices across the Confederacy, measured in Confederate dollars, rose dramatically year over year as the war continued, a classic case of a government printing its way out of a funding shortfall and paying for it in the coin of ordinary people's savings. Confederate citizens grew increasingly reluctant to accept the paper at face value, preferring barter, or when available, gold or Union currency instead, which only accelerated the currency's decline, as fewer transactions used it willingly. By the war's final year, some households reportedly resorted to using Confederate bills as wallpaper or kindling, having concluded the paper was more useful as material than as money. When the Confederacy itself ceased to exist in the spring of 1865, the currency's collapse was instant and total, since nothing had ever backed it except confidence in a government that no longer governed anything. The bills survive today mostly as souvenirs, worth more as paper artifacts than they ever were as money. By the autumn of 1923, workers in Germany were sometimes paid twice in a single day, once in the morning and once at lunchtime, because prices could rise so fast between the two paychecks that waiting until evening to spend the money meant losing real value to inflation in the hours in between. The German government, saddled with reparations payments from the First World War and facing a budget deficit it had no easy way to close through taxation, financed much of the shortfall by printing more currency, a practice that had already caused meaningful inflation in the years right after the war. The crisis accelerated sharply in 1923, after France and Belgium occupied the industrial Ruhr region to enforce reparations payments, and German workers there staged a passive resistance campaign that the government funded again, largely by printing money. Prices that had already been rising for years now doubled within days, and eventually within hours, and the exchange rate against the United States dollar, which had stood around 4 marks to the dollar before the war, reached figures in the trillions by late 1923. The wheelbarrow became the era's defining image, not as exaggeration but as literal necessity. Buying ordinary groceries required carrying enough banknotes to fill one, and some accounts describe people abandoning wheelbarrows full of nearly worthless bills because the wheelbarrow itself was worth more than its contents. Savings held in marks, the kind ordinary pensioners and small depositors had built over a lifetime, were wiped out almost entirely, a wound that lingered in German public memory for the rest of the century. The crisis ended abruptly in late 1923 when the government introduced a new currency, the Rentenmark, backed not by gold, which Germany had little of, but by a mortgage on the nation's industrial and agricultural land, and confidence returned almost as fast as it had collapsed. The wheelbarrows went back to hauling coal. Zimbabwe's central bank issued a banknote with a face value of $100 trillion in early 2009. Printed on the same paper stock, and in roughly the same size as much smaller denominations, a physical object that by the time it reached circulation could barely buy a loaf of bread. The crisis behind that banknote had been building for years. A land redistribution program beginning around 2000 disrupted the commercial farming sector that had underpinned much of ZimBPHW's export earnings and foreign currency reserves, and as the economy contracted, government spending, including large payouts to war veterans and a costly military involvement abroad, continued regardless. Facing shrinking tax revenue and mounting spending, the government financed the gap the way many governments in crisis eventually do, by printing more currency in ever larger denominations as each new batch of notes lost value faster than the last. Inflation, already high through the mid-2000s, accelerated into a runaway spiral by 2007 and 2008, with prices reportedly doubling in periods measured in single days at the worst point, a pace that made ordinary commerce almost impossible. Shopkeepers changed price tags multiple times before closing time, and workers who received a salary at the start of a month found it had lost most of its purchasing power before the month ended. The government's response was to keep issuing notes with more zeros, culminating in the $100 trillion bill, itself only worth a few US dollars by the time it appeared. In early 2009, the government effectively abandoned the currency, allowing citizens to conduct transactions in US dollars, South African rand and other foreign currencies instead, a de facto dollarization that finally halted the spiral, though it left the country without a functioning currency of its own for years afterward. The $100 trillion note survives now mostly in souvenir shops, sold for a few real dollars to tourists. For a decade, an Argentine peso and a United States dollar were, by law, worth exactly the same amount, a fixed exchange rate designed to end a history of runaway inflation, and for years it worked well enough that Argentines could travel abroad and shop as though their currency were as strong as any in the developed world. The arrangement, called the convertibility plan and introduced in 1991, required the central bank to hold enough dollar reserves to back every peso in circulation, a discipline that did successfully crush the hyperinflation Argentina had suffered through in the late 1980s. But a fixed exchange rate is only as strong as the economy underneath it, and through the late 1990s, Argentina's export competitiveness suffered as the dollar itself strengthened globally, dragging the pegged peso up with it and making Argentine goods more expensive on world markets than its neighbours' currencies allowed for. Government borrowing, meanwhile, kept climbing to cover budget deficits, and by 2001 investors increasingly doubted Argentina could keep servicing that debt while also maintaining the peg. Capital began fleeing the country, savers rushed to convert pesos into dollars and move the money abroad, and the government, desperate to stop a run on the banking system, imposed strict withdrawal limits in December 2001, known as the Corralito, effectively freezing ordinary Argentines out of their own savings accounts. The restrictions triggered street protests and riots severe enough to force the resignation of the president within days, and Argentina cycled through several presidents in the space of about 2 weeks before formally defaulting on its foreign debt and abandoning the dollar peg entirely. The peso, freed to float, lost roughly 70% of its value against the dollar within months, and the years of savings many Argentines had held, believing their money was as good as a dollar, were suddenly worth a fraction of that. The one-to-one peg lasted exactly as long as the world agreed to believe in it. On a single day in August 1998, the Russian government announced it would default on its domestic ruble debt, devalue the currency, and impose a moratorium on payments to foreign creditors, 3 separate financial disasters delivered in the same afternoon. Russia's finances in the mid-1990s had rested heavily on short-term government bonds called GKOs, sold at increasingly high interest rates to attract buyers as investors grew more nervous about the country's ability to repay them, a pattern that let the government keep borrowing right up until it could not anymore. Falling oil prices through 1997 and 1998 hit Russia's export earnings hard, since oil and gas made up a large share of the government's revenue, and tax collection domestically remained notoriously weak throughout the post-Soviet transition. As doubts about repayment grew, foreign investors who had piled into the high-yielding GKOs began pulling money out, forcing the central bank to spend down its foreign currency reserves trying to defend the ruble's exchange rate. By August, the reserves were nearly exhausted, and the government chose default and devaluation rather than continuing to burn through what little remained. The ruble lost a large share of its value within weeks, ordinary Russian savings evaporated in real terms, and foreign banks and hedge funds that had bought Russian debt, believing a nuclear-armed major power was effectively too important to be allowed to default, took heavy losses almost overnight. Among the hardest hit was an American hedge fund called Long-Term Capital Management, whose highly leveraged trading positions assumed markets would behave in historically ordinary ways, an assumption Russia's default shattered along with a great deal of the fund's capital in the space of a few weeks. The default that was supposed to be unthinkable simply happened, on a Monday at a press conference. 2 of the partners running a hedge fund founded in 1994 had, just a few years earlier, shared the Nobel Prize in Economics for work on how to price financial risk, and their fund's own risk models still failed to anticipate the event that nearly destroyed it. Long-term capital management traded enormous positions across global bond and derivatives markets, using strategies built on sophisticated mathematical models of historical price relationships, borrowing heavily to amplify what looked, in isolation, like small and reliable profit opportunities. The fund's leverage at its peak was extreme by any standard, with borrowed money financing a large multiple of its actual capital, an approach that magnifies gains when the models are right and magnifies losses catastrophically when markets move in ways the models never anticipated. Russia's default and ruble devaluation in August 1998 did exactly that. Markets around the world reacted with a flight to safety that broke the historical price relationships LTCM's models depended on, and positions that were supposed to move independently of each other instead moved together, all against the fund at once. Within about 6 weeks, the fund lost the large majority of its capital, and because its positions were so large relative to the markets it traded in, Regulators worried that an uncontrolled collapse could seize up bond and derivatives markets well beyond the fund itself. The Federal Reserve Bank of New York organized, though did not directly fund, a rescue in which a consortium of major banks put in enough capital to take over and gradually unwind the fund's positions, rather than dumping them all at once into a panicked market. No public money changed hands directly, but the episode raised uncomfortable questions about how a fund run by some of the most credentialed minds in finance had built a portfolio that assumed markets would never move the way. Markets, in fact, sometimes do. The models were elegant. The markets, that August, were not obliged to agree with them. A single bond trader working out of a Beverly Hills office far from his firm's Wall Street headquarters generated so much revenue for Drexel Burnham Lambert in the 1980s that his personal compensation in some years reportedly exceeded $500 million, a figure that made him, on paper, one of the highest paid people in the country. Michael Milken had built his career on a contrarian bet made years earlier as a researcher that lower-rated corporate bonds, dismissed by most of Wall Street as junk, were systematically underpriced relative to their actual default risk, and that a disciplined investor could earn outsized returns buying them. Milken turned that insight into an entire financing machine at Drexel, using high-yield bonds to fund corporate takeovers, including hostile takeovers of companies far larger than the firms initiating them, a practice that reshaped American corporate finance and made Drexel enormously profitable in the process. The firm's rapid rise drew regulatory scrutiny, and in the late 1980s, federal prosecutors, building partly on testimony from arbitrageur Ivan Bosky, who had himself been caught in an insider trading investigation, charged both Milken and Drexel with securities fraud, including allegations of stock parking and other schemes to disguise ownership and manipulate prices. Facing the prospect of an indictment that could have destroyed client confidence overnight, Drexel itself pleaded guilty to 6 felony counts in 1988, paying a large fine, though the firm's underlying junk bond business had already begun struggling as the market it had built started to sour amid a wave of defaults among the very companies it financed. Drexel filed for bankruptcy in February 1990, and Milken separately pleaded guilty to securities violations, serving time in federal prison and paying substantial fines and settlements. The junk bond market Milken built outlived the firm that invented it. More than 1,000 savings and loan institutions across the United States, the small local thrifts that generations of Americans had used to save for a house down payment, failed over roughly a decade, and the cleanup eventually cost taxpayers an estimated $130 billion. Savings and loans had traditionally operated on a simple model: take in customer deposits and lend the money out as long-term, fixed-rate home mortgages, a business that worked reliably as long as interest rates stayed relatively stable. When inflation and interest rates surged in the late 1970s and early 1980s, thrifts found themselves paying rising rates to keep deposits from fleeing to higher-yielding alternatives, while still collecting income from old mortgages locked in at much lower fixed rates from years earlier, a mismatch that squeezed many institutions toward insolvency, almost regardless of how well they were otherwise run. Regulators responded in the early 1980s by loosening restrictions on what thrifts could invest in, hoping riskier, higher-yielding assets like commercial real estate and junk bonds would help them earn their way back to health. Some institutions used the new freedom responsibly. Many others, freed from older restrictions and backed by federal deposit insurance that meant depositors bore little risk regardless of how the thrift performed, poured money into speculative real estate ventures and other high-risk lending, and a number of thrift executives engaged in outright fraud, looting their own institutions through self-dealing loans and inflated asset valuations. As the riskier investments soured through the mid and late 1980s, failures accelerated, and Congress eventually created the Resolution Trust Corporation to take over failed thrifts, sell their assets, and absorb the losses, a cleanup that stretched into the 1990s and left federal deposit insurance funds and taxpayers covering a bill few institutions had ever expected to run up. The corner thrift with the friendly teller turned out to be carrying risks nobody outside its own boardroom could see. Continental Illinois National Bank had grown, through the 1970s, into one of the largest commercial banks in the United States by aggressively lending to the American energy sector, a strategy that worked beautifully while oil prices climbed and fell apart with striking speed once they stopped. A significant share of Continental's risky energy loans, it turned out, had originally been made by a much smaller Oklahoma bank called Penn Square Bank, which had made a business of lending aggressively to oil and gas ventures and then selling participations in those loans to larger banks eager for the higher returns energy lending offered Continental among the largest buyers. When Penn Square itself failed in 1982, regulators and depositors began scrutinizing the quality of the loans it had originated and sold onward, and Continental's own exposure to bad energy debt became impossible to hide. Unlike a typical bank run involving nervous individual depositors lining up outside branches, Continental's crisis in 1984 was driven largely by large institutional depositors, foreign banks and corporations holding uninsured deposits well above the federal insurance limit, who could move money electronically the moment confidence cracked, and did so within days rather than weeks. Regulators, worried that Continental's failure could ripple through the correspondent banking relationships it held with thousands of smaller banks across the country, arranged an unprecedented rescue. The FDIC guaranteed all deposits, insured or not, injected capital directly into the bank, and effectively took an ownership stake, keeping Continental operating rather than letting it fail outright. A congressman remarked during hearings that the government had implicitly declared some banks too big to fail, a phrase that stuck and has shadowed banking policy debates ever since. The bank survived, the phrase that described why has outlasted it. A single trader in a bank's small Singapore office managed, over roughly 3 years, to lose an amount of money greater than the entire capital of the 233-year-old institution employing him, and almost nobody in the bank's London headquarters noticed until it was far too late to matter. Nick Lee-sun had been sent to Singapore to run what was meant to be a modest arbitrage operation trading futures contracts, tied to the Japanese Nikkei stock index, exploiting tiny price differences between exchanges. Somewhere along the way, Lee-sun began taking large unauthorized speculative positions instead, betting on the direction the Nikkei would move, and when those bets went wrong he hid the resulting losses in an internal account numbered 88888, which he had originally set up, by his own later account, to cover a junior colleague's small trading error, and then began using to bury his own much larger ones. BIRing's internal controls failed to catch the problem partly because Lee-sun held both the trading desk role and the back-office settlement role in Singapore, the same person who made the trades also confirming and reconciling them, separation of duties failure that any competent audit should have flagged years earlier. Lee-sun kept doubling down, hoping to trade his way back to even, and a major earthquake that struck the Japanese city of Kobe in January 1995 sent Asian markets tumbling in a direction that made his hidden positions catastrophically worse rather than better. By the time Lee-sun fled Singapore, and BIRing's management finally understood the scale of what had happened, the losses had reached roughly £827 million, more than the bank's entire capital base. BIRing's, unable to absorb the loss, was declared insolvent and sold to a Dutch bank for the symbolic sum of £1. Its name kept alive afterward only as a division of somebody else's institution. The signature on the door changed. The 3 centuries behind it did not survive to see it. An internal auditor at a telecommunications company, working largely on her own initiative and after hours, uncovered an accounting fraud in 2002 that turned out to be the largest of its kind American regulators had ever prosecuted, simply by asking why certain expenses on the books did not add up the way they should have. WorldCom had grown through the 1990s telecommunications boom into one of the largest long-distance and internet backbone providers in the country, expanding aggressively through acquisitions, financed heavily by debt and stock, an approach that worked as long as the company's share price kept climbing and new deals kept closing. When the telecom sector's growth slowed sharply around 2000 and 2001, WorldCom's actual earnings could no longer keep pace with what Wall Street expected, and Chief Financial Officer Scott Sullivan directed a scheme to close the gap on paper. Ordinary line cost expenses, essentially the fees WorldCom paid other carriers to complete calls over their networks, were reclassified on the books as capital expenditures, investments in long-term assets that get spread out and depreciated over years rather than counted as an immediate cost against profit. The reclassification made WorldCom's earnings look dramatically healthier than they actually were, to the tune of roughly $11 billion across several quarters. Internal auditor Cynthia Cooper grew suspicious of unexplained capital expenditure entries and, working quietly with a small team to avoid tipping off the executives responsible, traced the fraud back to Sullivan's direction before bringing it to the company's board and outside auditors. WorldCom filed for bankruptcy within weeks of the disclosure, at the time the largest corporate bankruptcy in American history, and Chief Executive Bernard Ebbers was later convicted of fraud and conspiracy, receiving a lengthy federal prison sentence. The auditor who found it kept the receipts long after the company that generated them was gone. For roughly 15 years, and by some later estimates considerably longer, a respected Wall Street figure told investors their money was earning steady, unusually consistent returns through a strategy he called split-strike conversion, when in fact no trading of any consequence was happening at all. Bernie Madoff had built a genuine and respected career as a market maker, and later as chairman of the Nasdaq Stock Exchange's governing body, a reputation that made his separate investment advisory business seem beyond question to the thousands of individuals, charities and institutions who entrusted him with their savings. The advisory arm's supposed strategy involved buying stocks and hedging with options, but investigators later found the firm simply took in new investor money and used portions of it to pay steady, attractively smooth returns to existing investors, the classic mechanic of a Ponzi scheme, one that depends entirely on new money continuing to flow in faster than existing investors asked to withdraw it. Madoff's returns were suspiciously smooth even during years when actual markets swung wildly, a pattern that a financial analyst named Harry Markopulos flagged to regulators repeatedly across nearly a decade, with detailed mathematical arguments that the returns were essentially impossible to achieve through the described strategy. The Securities and Exchange Commission investigated multiple times without uncovering the fraud. The scheme finally collapsed in December 2008. When the broader financial crisis prompted a wave of investors to request withdrawals simultaneously, more than the fund could possibly cover, since the money had never really been invested in the way clients believed. Madoff confessed to his sons, who reported him to authorities, and he pleaded guilty in 2009 to running what prosecutors described as history's largest Ponzi scheme, receiving a 150-year prison sentence and dying in federal custody in 2021. The statements kept arriving month after month, describing money that had stopped existing years before anyone read them. Over a single weekend in September 2008, federal officials, bank executives, and lawyers crowded into the New York Federal Reserve's offices, trying to find a buyer for a 158-year-old investment bank, and when no deal materialized by Monday morning, that bank simply ceased to exist, filing what remains the largest bankruptcy in American history. Lehman Brothers had, like several rivals, built up enormous exposure to mortgage-backed securities and related real estate investments during the housing boom of the mid-2000s, financing those holdings with borrowed money at ratios that left the firm with very little capital cushion if the underlying mortgages ever soured. When housing prices began falling and mortgage defaults climbed through 2007 and into 2008, the value of Lehman's real estate holdings fell with them, and the firm's counterparties and lenders grew increasingly reluctant to keep extending it credit, since nobody outside the firm could be entirely sure how deep the losses actually went. Earlier that same year, the Federal Reserve had helped arrange a rescue of a smaller but similarly exposed investment bank, Bear Stearns, engineering its sale to JP Morgan Chase with government backing for some of the riskier assets involved. When Lehman's turn came in September, officials chose a different path, reportedly reluctant to use public money to rescue another investment bank, and unable to find a private buyer willing to take on Lehman's liabilities without government support. Barclays and Bank of America both examined the firm over that final weekend, and both ultimately walked away, Bank of America choosing instead to acquire the troubled brokerage Merrill Lynch. Lehman filed for bankruptcy in the early hours of September 15, and the shock of watching a firm that size fail, with no safety net, sent credit markets worldwide into a freeze, deepening what had already been a serious financial crisis into what many economists consider the worst downturn since the Great Depression. The Tower kept the Lehman name on its lobby directory for exactly as long as it took to change the sign. 3 privately owned banks in a country of roughly 300,000 people had, by 2008, grown their combined balance sheets to something like 10 times the size of Iceland's entire national economy, an imbalance so extreme that when the banks failed, the country itself briefly appeared close to failing along with them. Iceland had privatized its major banks in the early 2000s, and the newly independent institutions expanded aggressively abroad over the following years, borrowing heavily on international wholesale funding markets and offering unusually attractive interest rates on savings accounts, including an online product called Isisav that drew large numbers of ordinary depositors in Britain and the Netherlands, looking for a better return than domestic banks offered. This model depended entirely on being able to keep borrowing cheaply on international markets to fund the bank's growing balance sheets, since the deposits and assets involved vastly exceeded what Iceland's small domestic economy could plausibly support or backstop on its own. When the global financial crisis froze international lending in 2008, Iceland's banks found themselves unable to refinance the enormous debts they had built up, and within a single week in October 2008, all three of the country's major banks collapsed and were taken over by the government, which itself had nowhere near the resources to guarantee deposits at the scale the banks had grown to. Iceland's currency, the krona, lost a large share of its value almost overnight, and a bitter diplomatic dispute followed with the British and Dutch governments, which had compensated their own citizens' Isisav deposits, and then demanded Iceland repay them, a dispute that dragged through referendums and courts for years afterward. Iceland's economy contracted sharply in the immediate aftermath, but recovered faster than many expected, helped by a currency devaluation that made the country's exports and tourism suddenly much cheaper for foreign visitors. The banks that once dwarfed their own country left it, in the end, considerably smaller than it had looked on paper. Television cameras filmed lines of depositors stretching down British high streets outside branches of Northern Rock in September 2007. The first time queues like that had formed outside a British bank in more than 100 years, and the site itself did as much damage to confidence as the underlying financial problem had. Northern Rock had grown rapidly in the years before the crisis by funding its mortgage lending less through ordinary customer deposits, the traditional and more stable source of bank funding, and more through short-term borrowing on wholesale money markets, essentially borrowing from other financial institutions to fund its own lending, a model that offered faster growth but depended on those wholesale markets staying open and reasonably priced. When the early stages of what would become the global financial crisis caused wholesale lending between banks to freeze up in the summer of 2007, largely due to spreading fears about subprime mortgage exposure across the banking system, Northern Rock found itself unable to refinance its short-term borrowing even though its own mortgage book was, at that point, still performing reasonably well. The bank approached the Bank of England for emergency liquidity support, a request that under normal circumstances might have been handled quietly, but news of the request leaked to the press before the support could be properly announced and explained to the public. Ordinary depositors, seeing headlines about a bank needing emergency central bank support, reasonably concluded their own money might be at risk, and began queuing to withdraw it, even though retail deposits were not actually the source of the bank's problem. The run accelerated Northern Rock's difficulties regardless, and after failed attempts to find a private buyer, the British government took the bank into full public ownership in February 2008, the first major nationalisation of a British bank since the 1970s, and an early visible sign of the crisis that was about to spread much further. The queues that formed outside its branches turned out to be an early warning for a much larger storm still building offshore. A company that claimed its proprietary device could run hundreds of different diagnostic blood tests from a single drop of blood taken from a finger. Prick reached a private valuation of roughly $9 billion before a newspaper investigation revealed the device largely did not work as described at all. Theranos was founded by Elizabeth Holmes, a Stanford dropout whose confident presentation style and comparisons to Steve Jobs helped the company attract a board stacked with prominent former officials and enormous sums of investment capital, much of it from investors who reportedly received little independent technical verification of the underlying science before writing large checks. The company's supposed breakthrough device, called Edison, was meant to replace the standard practice of drawing multiple vials of blood for lab testing, with a single finger prick sample analysed in-house, a genuinely appealing promise for anyone who has ever dreaded a blood draw. Internally, however, the Edison devices reportedly produced unreliable results for many of the tests Thierry claimed they could run, and the company covered the gap, according to later reporting and testimony, by secretly diluting patient samples and running them on modified conventional lab equipment purchased from competitors, equipment the company had publicly implied its own technology had made obsolete. A Wall Street Journal investigative reporter named John Carre Arrow, tipped off by a source inside the company, spent months building a case that the technology was far less capable than represented, publishing the first of several exposés in 2015. Regulatory inspections that followed found serious deficiencies in the company's lab practices. Patients had in some cases received inaccurate test results with real medical consequences, and the company's partnerships and valuation collapsed within about 2 years. Holmes was convicted of fraud in 2022 and sentenced to federal prison. The device that was supposed to need only a drop of blood never delivered the hundreds of tests it promised. A small Canadian mining company with a share price once measured in pennies became, for about 2 years in the mid-1990s, one of the most exciting stories on the Toronto Stock Exchange, its stock climbing to a peak valuation near $6 billion on the strength of what it said was the discovery of one of the largest gold deposits ever found, at a site called Busang in the Indonesian jungle. Bribed Minerals had staked claims at Busang based on drilling samples that its geological team, led by a Filipino-Canadian geologist named Michael de Guzman, reported as showing extraordinarily rich gold content, results that, if accurate, would have ranked among the richest gold discoveries in mining history. Major mining companies competed to partner with or acquire in the project, and Indonesian government officials, including relatives of the country's president, became involved in negotiating who would ultimately develop the site, a level of political interest that itself signalled how seriously the discovery was being taken. Freeport-McMoRan, a major mining company that had agreed to partner on developing the site, sent its own independent geological team to verify the results before finalising the deal, standard due diligence for a discovery of this claimed size. Their samples came back showing negligible gold, essentially none of the concentration Bribed had reported for years. Investigation afterward concluded that the original samples had likely been salted, meaning gold from outside sources had been deliberately added to core samples to fake high-assay results, though who exactly orchestrated the fraud was never fully resolved. Michael de Guzman died after falling from a helicopter over the Indonesian jungle just days before the independent results were announced, in circumstances that remain disputed between suicide and other explanations, and no one was ever convicted of orchestrating the fraud itself. Bribed's stock, once worth billions on paper, became essentially worthless within days of the announcement. The jungle at Busang held gold in exactly the quantity nature had put there, which was almost none. Inspectors sent to verify a New Jersey company's vast storage tanks of soybean oil that had been used as collateral to secure enormous loans from banks and brokers across Wall Street, discovered in late 1963 that many of the tanks contained mostly seawater, with just enough oil floating on the surface to fool anyone who dipped a measuring rod in from the top. Tino Dare, Angeles ran Allied Crude Vegetable Oil Refining Company, a commodities trading business built around vegetable oil futures, and had figured out that warehouse receipts, official-looking documents, certifying stored quantities of a commodity could be used as collateral for loans without lenders necessarily inspecting the physical inventory themselves each time. Dare used those receipts to borrow heavily and speculate on the direction of soybean oil futures prices, and to make the underlying tanks appear to hold far more oil than they actually did. His operation reportedly ran pipes connecting supposedly separate storage tanks, so oil could be shifted between tanks during different inspections, along with the seawater trick that let a thin surface layer of real oil disguise mostly empty or water-filled tanks below. American Express, through a subsidiary, had guaranteed a large volume of these warehouse receipts, a business the company had entered almost as an afterthought, and found itself exposed to enormous losses once the fraud came to light. The scheme unravelled when Dare and jealous speculative bets on soybean oil prices went wrong at a scale he could no longer cover, prompting closer scrutiny of the collateral behind his borrowing, and the resulting inspection exposed the doctored tanks. The scandal cost American Express tens of millions of dollars and briefly threatened the company's stock price badly enough that a young investor named Warren Buffett, betting the underlying business remained sound despite the scandal, bought a large stake at depressed prices, a trade later remembered as one of his early formative successes. The tanks kept their oil-slick surface right up until someone finally looked past it. An airline that had once been so synonymous with international air travel that its name appeared in science fiction films as the default carrier of the future ceased flying altogether on a single day in December 1991, its final flight landing with almost no advance public announcement that it would be the last. Pan American World Airways had pioneered transatlantic passenger service in the 1930s and later the first round-the-world commercial flights, building a brand that for decades represented glamorous international travel more than any of its competitors did, flying into airports around the world, often before any other American carrier had a presence there. The airline's business model had been built for an era of regulated international air travel, when routes and fares were often protected by government agreement rather than open competition, and Pan Am, unlike most of its major American rivals, had never built a substantial domestic route network to fall back on for stable revenue. When the United States deregulated its airline industry in 1978, competition intensified sharply on international routes, just as Pan Am was structurally least prepared to weather it, and the airline began selling off valuable assets, including its Pacific division and its landmark headquarters building in New York, simply to keep operating. Rising fuel costs through the 1970s and 1980s squeezed the airline further. Then, in December 1988, a bomb planted by Libyan agents destroyed Pan Am Flight 103 over Lockerbie, Scotland, killing everyone aboard and 11 people on the ground, a tragedy that also inflicted lasting reputational and financial damage on an airline already struggling, as lawsuits, security concerns and falling bookings compounded its existing problems. Pan Am filed for bankruptcy in January 1991 and attempted to keep flying a reduced schedule while seeking a buyer, but a deal with Delta Airlines to take over some routes fell through under the weight of continuing losses, and the airline shut down entirely that December. The Blue Globe logo that once meant the whole world was reachable came down for the last time that winter. A company that had been building wagons since before the American Civil War, and had supplied wagons to the Union Army during that war, successfully reinvented itself as an automobile maker in the early 20th century, and then, more than 100 years after its founding, quietly stopped making cars altogether in 1966, unable to keep pace with much larger competitors. Studebaker had genuine strengths as an automaker for decades, known for engineering quality and, in the post-war years, for striking design work, including cars that drew real acclaim. The company's underlying problem was structural rather than a single bad decision. Its main manufacturing complex in South Bend, Indiana, was older and less efficient than the newer plants Ford, General Motors and Chrysler had built, giving Studebaker persistently higher production costs per vehicle than the industry's dominant firms, a disadvantage that compounded year after year as the bigger automakers used their scale to keep prices competitive, while Studebaker's margins thinned. A 1954 merger with luxury automaker Packard was meant to create a stronger combined company, but Packard was itself struggling, and the merger mostly combined two weakening companies' problems rather than solving either one. Labour costs at the aging South Bend plant, negotiated years earlier under more favourable conditions, further widened the cost gap against competitors building in newer facilities. Through the late 1950s and early 1960s, the company tried various strategies, including a compact car aimed at cost-conscious buyers and diversification into non-automotive businesses, to keep the automotive side afloat, but the underlying math never closed. Studebaker closed its South Bend plant in December 1963, continuing limited production for a couple more years at a smaller Canadian facility, before shutting down vehicle manufacturing entirely in March 1966. The wagon works that had outlasted one war did not outlast the automobile industry it helped invent. An engineer at East Kodak named Stephen Sasson built a working digital camera prototype in 1975, a toaster-sized device that recorded images to a cassette tape, and when he demonstrated it to company executives, The reported reaction was less excitement than concern about what it might do to the film business that had made Kodak one of the most profitable companies in America. Kodak had spent most of the 20th century as the dominant name in film photography worldwide, a business built on selling not just cameras, but the film, chemicals and paper that customers had to keep buying every time they wanted new pictures, a recurring revenue model that made the film side of the business extraordinarily profitable compared to a one-time camera sale. Sassoon's digital prototype threatened that entire model directly. A digital camera needed no film at all, which meant no recurring purchase, which meant, from a purely financial standpoint, executives who depended on film profits had genuine reason to see the invention as a threat to manage carefully rather than a breakthrough to rush to market. Kodak did continue researching digital imaging over the following decades and even held key patents in the space, but the company's product strategy and marketing muscle stayed weighted toward defending film for far longer than the underlying technology trends justified, while competitors, including Japanese camera makers with less legacy film revenue to protect, moved faster into digital cameras through the 1990s. By the time Kodak committed seriously to digital products, rivals had already captured much of the market, and the rise of camera phones in the 2000s then undercut standalone digital cameras too, shrinking the market Kodak had finally entered. Kodak filed for Chapter 11 bankruptcy protection in January 2012, emerging afterward as a much smaller company focused on commercial printing and imaging rather than consumer photography. The company that invented the future of the camera spent decades protecting the past instead. Blockbuster executives, according to widely reported accounts from people involved, had the opportunity in the early 2000s to acquire a small, unprofitable DVD by mail company called Netflix for a sum in the tens of millions of dollars and turned it down, reportedly seeing little strategic value in a business built around mailing discs to customers' homes. Blockbuster's own business at the time was built on a network of thousands of physical rental stores, and a revenue model that depended heavily on late fees charged when customers returned movies past their due date, fees that by some estimates made up a meaningful share of the company's profit. Netflix's core innovation was removing that friction entirely, a flat monthly subscription with no due dates and no late fees, mailed directly to a customer's home, a model that looked unglamorous and unprofitable in its earliest years, but that solved the single most common customer complaint about renting from a store like Blockbuster. Blockbuster did eventually respond, launching its own DVD by mail service and dropping late fees around 2005, moves that cost the company real money and slowed Netflix growth for a period. But by then, Netflix had a head start in logistics, customer data, and brand association with the mail order model that Blockbuster struggled to close. The company was also carrying substantial debt, from a leveraged buyout structure dating to its years under media conglomerate Viacom, which limited how much capital it could invest in catching up. As Netflix began shifting towards streaming video around 2007, ahead of most competitors including Blockbuster, the gap widened again, and Blockbuster's store-based model, still generating real if declining revenue, increasingly looked like an anchor rather than an advantage. The company filed for bankruptcy in September 2010, and by 2019 the very last operating Blockbuster store, in Bend, Oregon, had become a minor tourist attraction, a physical curiosity from a rental model the rest of the industry had left behind. The last store kept its shelves stocked for customers who came by then, mostly to look rather than to rent. A sock puppet with a microphone became, for a brief period around the turn of the millennium, one of the most recognized advertising characters in America, appearing in a Super Bowl commercial and even on a parade float, promoting an online pet supply company that would be out of business within roughly a year of that Super Bowl appearance. Pets.com launched with the straightforward premise that pet owners would rather order bulky items like dog food and cat litter online than haul them home from a store themselves, a reasonable enough consumer insight. The company's actual economics undercut that premise almost immediately. Pet supplies are heavy, low margin and expensive to ship relative to their sale price, meaning every order Pets.com fulfilled often cost the company more in shipping and warehousing than it earned in revenue, a gap that no amount of marketing cleverness could close on its own. Rather than solving that underlying cost problem first, Pets.com spent aggressively on brand building, including a widely remembered Super Bowl advertisement in January 2000 that boosted awareness of the sock puppet mascot dramatically without meaningfully fixing the losses generated by every actual sale. The company went public in February 2000, raising further capital from investors caught up in broader enthusiasm for internet retail stocks. But when the wider dot-com market began collapsing that spring, further funding rounds became impossible to secure at any price, and Pets.com, having burned through roughly $300 million in total funding without ever approaching profitability, shut down in November 2000, liquidating its inventory and laying off its staff within days of the announcement. The sock puppet itself, oddly, outlived the company that created it, later resurfacing as a mascot for other pet-related ventures, stranger afterlife than the business it originally represented ever achieved. The puppet kept working long after the company that hired it had nothing left to sell. Toys R Us, a retailer that had dominated the American toy market for decades, filed for bankruptcy in September 2017, carrying roughly $5 billion of debt, a burden that traced back not primarily to falling toy sales, but to a leveraged buyout completed more than a decade earlier. In 2005, a group of private equity firms and a real estate investment trust acquired Toys R Us in a leveraged buyout, a transaction structure in which the buyers finance most of the purchase price with borrowed money and then load that debt onto the acquired company itself rather than paying it off from their own funds. Toys R Us, which had been a healthy if unglamorous retailer before the deal, emerged from the buyout owing roughly $5 billion, requiring hundreds of millions of dollars a year simply in interest payments before the company earned a cent toward actually running or improving its stores. That interest burden left little capital available for the kind of investment retailers increasingly needed through the 2000s and 2010s to compete with Amazon's expanding online catalog and Walmart's aggressive pricing, both of which ate into Toys R Us traditional toy sales without the company having the financial flexibility to respond effectively. The retailer's underlying stores and brand still had real customer loyalty. Children and parents alike had genuine affection for the format, and the company's toy sales, while pressured, were not collapsing at anything like the rate its finances suggested trouble. When Toys R Us filed for bankruptcy in 2017, hoping to restructure around a smaller, more sustainable debt load, disagreements among creditors over how to divide the shrinking pool of value ultimately led the company to liquidate entirely, rather than reorganize, closing all its American stores by 2018 and laying off roughly 30,000 employees, a closure widely cited afterward as a case study in how debt from a buyout, not the underlying retail business, can be what actually kills a company. The shelves that had stocked a generation's childhoods were cleared out in a matter of months. For a stretch of the early 20th century, an American family could order an entire house, delivered by rail in pieces with instructions for assembly, from the same mail-order catalogue they used to buy shoes and farm tools. A company called Sears, Roebuck & Company that once represented, more than perhaps any other single business, the sheer breadth of what American retail could offer. Sears built that dominance first through its catalogue business, reaching rural customers who had no easy access to a department store, and then through an enormous network of physical stores that by the mid-20th century anchored shopping centers across the country and made Sears for a time the largest retailer in the United States. The company's decline unfolded gradually across several distinct competitive waves rather than a single collapse. Discount retailers like Walmart and Kmart undercut Sears on price starting in the 1970s and 1980s. Specialty retailers picked off individual categories like electronics and tools that Sears had once sold as part of a broad general assortment, and then, starting in the 2000s, online retailers led by Amazon undercut both price and convenience at once. Sears merged with Kmart in 2005 under hedge fund manager Eddie Lampert, who became chairman and later chief executive, and pursued a strategy that critics characterized as prioritizing real estate value and financial engineering, including large stock buybacks and asset sales over reinvestment in the stores themselves. Supporters argued the underlying retail business was simply unsalvageable, and Lampert was extracting whatever value remained responsibly. Store closures accelerated through the 2010s as sales kept falling, and the company kept selling off valuable brands and properties to stay afloat. Sears filed for bankruptcy in October 2018, and while a small number of stores survived under new ownership afterward, The company that had once sold rural America entire houses by mail closed the overwhelming majority of its locations within a couple of years. The catalogue that once offered a whole life's worth of goods is a museum piece now, not a business. Radio Shack spent much of the 20th century as the place a hobbyist went to buy a specific resistor, wire, or vacuum tube for a home electronics project, a genuinely useful niche that few other stores bothered to serve, and by the time the company tried to become something else entirely, that original niche had mostly disappeared along with the customers who once needed it. As consumer electronics moved from something hobbyists built themselves toward mass-manufactured devices, nobody opened up and repaired. Radio Shack's traditional parts business shrank steadily through the late 20th century, and the company repositioned itself as a general consumer electronics retailer, selling televisions, phones, and eventually mobile phone service contracts alongside a dwindling shelf of components. That repositioning put Radio Shack in direct competition with much larger big-box electronics retailers like Best Buy, which could offer wider selection and better prices through sheer scale, and later with mobile carriers' own branded stores, which sold phones and plans directly without Radio Shack acting as a middleman. Radio Shack's stores, meanwhile, were generally smaller and less efficiently located than its bigger rivals, and the company struggled through the 2000s and 2010s to articulate a clear reason for a shopper to choose Radio Shack over either a big box store or, increasingly, online retailers who could beat its prices without the overhead of thousands of physical locations. The company filed for bankruptcy in 2015, closed roughly half its remaining stores, and was acquired by a hedge fund that kept a smaller footprint operating. A second bankruptcy followed in 2017, further shrinking the chain to a small number of locations and a licensing arrangement that kept the name alive mostly as a brand rather than as the store people remembered. The shelf of resistors and vacuum tubes had quietly disappeared years before anyone noticed the stores were emptying too. Ford spent roughly $250 million in years of market research developing an entirely new car brand aimed at a gap the company's researchers believed existed in the mid-priced automobile market, and discontinued the resulting cars less than 3 years after launch, having sold only a fraction of what internal projections had promised advertisers and dealers alike. The Edsel, named eventually for Henry Ford's son, after an elaborate and ultimately unsuccessful effort to find a more evocative name through outside consultants and even a commissioned poet, launched in September 1957 with an unusually aggressive marketing campaign that built public anticipation for months before anyone outside the company had actually seen the car. When the Edsel finally appeared, its distinctive vertical oval grille, meant to stand out on the road, instead drew widespread and fairly merciless public mockery, with commentators comparing it to everything from a horse collar to less flattering anatomical references. Timing worked against the car as much as design did. The Edsel launched just as a recession was taking hold in late 1957, and as consumer preferences were shifting towards smaller, more economical cars rather than the larger mid-priced vehicles the Edsel represented. Early production units also suffered from quality control problems, since the cars were built on shared assembly lines with other Ford and Mercury models under considerable schedule pressure, and dealers reported mechanical issues that further damaged the brand's reputation in its first crucial months on the market. Ford discontinued the Edsel brand in November 1959 after producing the car for roughly 2 model years, a failure significant enough that the name itself became, for decades afterward, a kind of shorthand in American business writing for a heavily hyped product that flopped. The grille that was meant to turn heads mostly just gave people something to laugh about. Coca-Cola's own market research showed, in blind taste tests conducted before the change, that consumers preferred a new, sweeter formula over both the existing Coca-Cola recipe and rival Pepsi, and the company changed its formula based on that research in April 1985, only to reverse the decision within about 3 months in the face of a backlash the research had entirely failed to predict. The change had been motivated partly by years of steadily eroding market share against Pepsi, driven in part by Pepsi's own advertising campaign inviting consumers to taste test the two colas side by side, a campaign that reliably showed many people preferring Pepsi's sweeter taste in a quick sip comparison. Coca-Cola's researchers took that finding seriously and developed a new formula that performed well in similar blind taste tests, and the company, confident in the data, discontinued the original recipe entirely rather than simply introducing the new formula as an additional option alongside it. What the taste tests had not measured, and arguably could not measure, was the emotional and cultural attachment a great many Americans held toward the original Coca-Cola taste and brand as something more than just a flavor to be optimized in a laboratory sip test. For many longtime drinkers, the specific taste of the original formula was tied up with memory and identity in ways a blind comparison of small samples never captured. The backlash was immediate and loud. The company reportedly fielded tens of thousands of complaint calls and letters, and organized protest groups formed specifically to campaign for the original formula's return. Coca-Cola brought the original recipe back within about 3 months, rebranding it Coca-Cola Classic, and selling it alongside New Coke, and Classic quickly recaptured the large majority of sales, effectively ending the New Coke experiment in everything but name for years afterward. Some executives later suggested, perhaps generously, that the whole episode had at least reignited public affection for the original brand more effectively than any ordinary advertising campaign could have. The formula everyone said they preferred in a sip test was not, it turned out, the one they wanted to actually drink for the rest of their lives. General Motors, a company that had been the world's largest automaker for most of the 20th century, filed for bankruptcy in June 2009, and for a period afterward, the United States government held a majority ownership stake in what had once been considered the ultimate symbol of American industrial might. GM's difficulties had been building for decades before the crisis that finally forced the bankruptcy filing. The company had negotiated generous pension and retiree healthcare benefits with its unionized workforce across the mid-20th century, commitments that made sense when GM dominated the American car market almost without serious competition, but that became an increasingly heavy fixed cost as foreign automakers, particularly Japanese manufacturers building more fuel-efficient and, by many accounts, more reliable cars, steadily took market share, starting in the 1970s and continuing for decades afterward. By the 2000s, GM was carrying legacy costs per vehicle that its leaner foreign competitors, many building at newer American plants without the same accumulated pension obligations, simply did not carry, a structural disadvantage that ate into profitability even in reasonably good years. The 2008 financial crisis then delivered the blow that decades of gradual erosion had left the company with too little cushion to absorb. Auto sales collapsed across the industry as credit tightened and consumer confidence cratered, and GM's cash reserves, already thinned by years of underlying weakness, ran out within months. The federal government, having already extended emergency loans in late 2008, structured a bankruptcy process in 2009 that used further government funding to keep the company operating through reorganization, shed a substantial portion of its debt and store of underperforming brands, and emerged with the government holding a majority equity stake, later sold down gradually over the following years as GM's finances stabilized. The government's investment was not fully recovered when the last shares were eventually sold, but the auto industry and its supplier network, employing far more workers than GM alone, were widely credited with having survived a crisis that could plausibly have taken much of it down at once. The largest automaker in the world spent a summer as a ward of the government that had once regulated it from a respectful distance. Silicon Valley Bank, a lender that had spent decades cultivating close relationships with technology startups and the venture capital firms that funded them, lost roughly $42 billion in deposits in a single day. In March 2023, a withdrawal pace so fast that regulators seized the bank within about 48 hours of the first serious signs of trouble. The bank's underlying business had grown enormously during the low interest rate years of the pandemic, as venture-funded startups flush with cash parked huge deposits with SVB, deposits the bank then invested heavily in long-dated government bonds and mortgage-backed securities, assets that were perfectly safe in the sense that they would eventually pay back their full value, but that lose market value in the meantime whenever interest rates rise, since newer bonds paying higher rates make older lower-yielding bonds worth less if sold before maturity. When the Federal Reserve raised interest rates rapidly through 2022 to fight inflation, the market value of SVB's bond portfolio fell sharply, a paper loss the bank did not need to realize as long as it never had to sell those bonds before they matured. The trouble was that SVB's depositor base, concentrated heavily among startups burning through cash reserves during a slower fundraising environment, began withdrawing deposits faster than usual around the same time, forcing the bank to sell some of its underwater bonds to raise cash, converting a paper loss into a real one and revealing the bank's weaker capital position publicly. Once that news spread, and it spread with unusual speed through venture capital group chats and social media, rather than through the slower channels of a traditional bank run, depositors, many holding balances well above the standard federal insurance limit, rushed to withdraw everything they could within hours. Regulators closed the bank on a Friday, and over the following weekend, worried about contagion spreading to other regional banks with similar depositor concentrations, took the unusual step of guaranteeing all deposits at SVB in full insured or not, to calm the broader banking system. The bonds were exactly as safe as advertised. They just were not worth what everyone needed them to be worth on the one day it mattered. Somewhere in Panama, the jungle has long since closed over the ditches the Scottish settlers dug at Darien, and nothing marks the spot where a nation's fortune went into the ground. The energy company that vanished in an afternoon left an office tower in Houston that changed hands twice before anyone stopped noticing whose name had been on the door. That is, in the end, what these 100 lessons have in common. The world absorbs each collapse with very little ceremony. The building gets a new tenant, the stock ticker gets reassigned to somebody else, the ledger closes, and closes quietly. It would be tidy to say each of these failures taught its industry a lasting lesson, and sometimes, for a while that is even true, regulators write new rules, boards ask sharper questions, a generation of bankers grows briefly cautious. But the shapes recur anyway, because the shapes were never really about railways or tulip bulbs or subprime mortgages. They were about people convincing themselves and each other that this time the ordinary rules had quietly stopped applying. Every failure on this list started with somebody who was neither foolish nor unusually greedy, doing something that made complete sense to them at the time. That is the part worth sitting with longer than any of the numbers. Not the size of the losses, not the names of the fallen banks, but the plain human ordinariness of how each of them got there. The ditch at DIREN filled back in with jungle a long time ago. Somewhere, quietly, another one is being dug,